In its relatively short history, the ARK Innovation ETF, ARKK, has had an incredible run. And it has an incredible narrative. It's investing in the future, and you don't want to be left behind. Unfortunately, beyond a couple of huge years, it has struggled to deliver on the narrative. Being left behind actually looks pretty good. Investors in ARKK, many of whom arrived late to the party, have experienced dramatic ups and downs with an emphasis on downs for most investors. The fund crashed 77% between 2021 and 2022 after taking huge inflows. The question anyone still holding this fund must be asking, or should be asking, is whether it will recover. I'm Ben Felix, portfolio manager at PWL Capital, and I'm going to tell you what the data say about technology bubbles, crashes, and the ability of active managers to make a comeback. The general thesis of ARKK is to invest in disruptive innovation. The areas of potential economic growth ARK has identified may well be revolutionary, but the relationship between revolutionary technologies and investment returns is not what many people think. Technology has persistently revolutionized the way that we live our lives for hundreds of years, but revolutionary technology has consistently been associated with asset price bubbles, extreme asset price increases followed by price declines. We had insurance and global trade in the 1720s, canals in the late 1700s and early 1800s, railroads in the mid-1800s, electricity in the late 1800s, huge advances in intangible capital measured by patents in the 1920s, and more recently, of course, the internet of the 1990s. There have been many smaller scale technology bubbles following a similar pattern. Bicycle company stocks in the UK in 1890, electronic stocks in the 1960s, biotech in the 1980s, and in recent history, cannabis, electric vehicles, and clean energy have all followed similar paths of extreme price increases, followed by sobering declines. One explanation for this persistent phenomenon is that as investors learn about a technology, stock prices associated with it increase rapidly on optimistic future cash flow expectations and relatively low sector-specific risk. In the event of successful broad adoption of the technology, its risks become more systematic, more connected to the overall market, driving stock prices down. In other words, the bubble behavior is explained by equilibrium asset pricing. The other explanation suggests that investors get too excited pushing stock prices above their fundamental values. This excitement is typically accompanied by a new era or this time is different narrative. This second explanation is plausible since we know investors make extrapolation errors, engage in intention-induced trading, and respond to sensationalized coverage from the media. An analysis of 88 revolutionary technologies over 150 years suggests that technology bubbles require uncertainty surrounding the innovation, the existence of pure play firms tightly coupled with the innovation, easy to understand narratives supporting the importance of the innovation, and the presence of novice investors fueled by over-optimism and overconfidence. Check, 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 and check in the case of ARKK. One of ARK's greatest strengths has been crafting an easy-to-understand narrative which won the hearts of many novice investors. This consistent historical pattern makes investing in revolutionary technology a questionable strategy. Unfortunately, it's one of the most common mistakes that I see new investors make. New investors specifically are relevant here because they have been found to be more prone to biases that lead to return chasing, potentially contributing to the existence of bubbles in the first place. They're more prone to extrapolating recent price movements, more heavily influenced by attention, and more prone to herding or following the crowd. I definitely see this happen. New investors tend to link expected economic growth to positive future investment returns, which is intuitive but wrong. The counterintuitive reality that expected economic growth and stock returns are somewhere between unrelated and inversely related due to the way that assets are priced is difficult to grasp. Asset prices reflect expected future cash flows discounted to today's dollars, where the discount rate is related to risk. Technologies with revolutionary potential have some combination of low discount rates and high expected cash flows driving their prices up. Eventually, discount rates increase and cash flow expectations are brought back to reality, causing the sharp drop that we see so consistently in the data. Financial product manufacturers seem to be well aware that exciting themes attract investor dollars. They strategically launch niche products that coincide with the price run-up of exciting themes, but unfortunately for the investors, funds tend to launch just after the peak of returns, going on to underperform risk-adjusted benchmarks. I know I'm painting a negative picture here, but technology bubbles are not all bad. They provide low-cost capital for innovative firms to implant new technologies in the economy. For example, just being added to an AI-labeled ETF boosts the price of AI-related companies, driving down their cost of capital. There have been similar effects in the past with other technologies, like adding .com or blockchain to a company's name, resulting in a temporary boost to its valuation. While this can be good, it also tends to attract lots of fraud. Even still, asset price bubbles have historically been associated with the construction of technological infrastructure that ultimately benefits the economy. But, as we should expect, investors supplying low-cost capital have not been the ones to benefit, and in many cases, it ends up being inexperienced investors left holding the bag. Based on the historical relationship between revolutionary technologies and stock returns, it seems unlikely that ARKK will make a comeback on that basis. But this ETF is actively managed. Even with the odds stacked against them, maybe they are skilled enough to make a comeback. There is a long history of star fund managers flaming out. Some recent examples from the dot-com era are worth considering. Garrett von Wagoner's Emerging Growth Fund launched in 1996, and in 1999, he delivered a 291% return, attracting $506 million of new investor dollars by the end of the year, mostly in November and December. Von Wagoner had a strong narrative. He was in San Francisco. He understood how innovation was going to impact the economy. He was even featured in a PBS Frontline episode in 1997 where viewers were told that no one had the golden touch more than him. After the huge 291% return in 1999, von Wagoner lost 21% in 2000, 60% in 2001, and another 64% in 2002. He stuck with it until early 2008, but was unsuccessful at making a comeback. Another wild story is Ryan Jacob, who took over the Kinetics Internet Fund in December 1997. He posted a 196% return in 1998 and a 216% return in 1999. Jacob started his own fund in 2000, the Jacob Internet Fund. The fund lost 79% in 2000, 56% in 2001, and 13% in 2002. $100,000 invested in the Jacob Internet Fund in 2000 would have been worth $8,000 by the end of 2002. Incredibly and impressively, gotta hand it to him, Jacob has stuck with it. The fund even returned 123% in 2020, though it gave up a lot of those gains in 2022. Since inception, the fund has returned 0.73% annualized through March 2024. I know these are just two examples, so I looked at 114 actively managed mutual funds that existed in 2000, still exist today, and suffered a drawdown of 70% or more at some point over that period. Drawdown is the maximum peak-to-trough decline that fund investors experienced. The drawdowns for most of these funds, unsurprisingly, had peaks starting in either 2000 or 2007. Many of them are sector funds focusing on specific sectors like financials, technology, and energy, but many are growth funds. The average time to recover from a 70% or greater drawdown in my sample is just over 14 years. And this does not account for inflation or the opportunity cost of not being in some other investment over that period. The other thing is that not all of the funds have recovered. Out of 114 funds in my sample, 28, or about a quarter of them, have yet to recover. One of the behaviors that may be related is risk shifting. If a manager has performed poorly in the past, they will take on more risk in an attempt to improve their performance and attract more assets. This is an interesting agency problem because the relationship between performance and flows is asymmetric. Funds with stellar performance attract inflows from investors, while poor performance is not equivalently penalized. This creates an incentive for fund managers to take big risks with poor risk-return trade-offs by increasing their weight in high beta stocks or concentrating their portfolio in a few risky stocks or industries. Empirically, funds that risk shift in an attempt to improve their performance generate significantly negative alphas. Despite these data, many investors will hold on to losing funds in hopes that they will recover. There are a few explanations for this behavior. One is the disposition effect. It is well documented that investors hold on to losing investments longer than they probably should due to loss aversion, mental accounting, pride, and regret. Another is the endowment effect. Investors place more value on an asset that they already own, so even if they hold something they wouldn't buy today, they may continue to hold it. I find one of the most useful exercises to overcome this issue is to imagine that you did not own the asset in question. Say it's ARKK. If you did not own it today and you had the cash instead, would you invest that cash in ARKK? The story arc for the ARK Innovation ETF so far follows a path that is well trodden throughout history. Exciting technologies increase related stock prices dramatically, some fund managers in that space end up delivering incredible performance and look brilliant while doing it, and then their performance falters along with the asset price bubble deflating. I can't predict the future. I don't know if ARKK will make a comeback. But the weight of evidence on revolutionary technology as an investment thesis, active managers' ability to recover from large drawdowns, and the agency problems with risk shifting suggest that it would not be wise to count on it. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you want to learn more about how PWL helps people avoid investing in funds like ARKK, and trust me, that is a conversation I had many times when ARKK had its years of high returns, you can book a meeting with us below.